and welcome to the Wall Street Blockchain Alliance's Preparing for Crypto Year-End workshop, the WSBA's last official event of 2021. Before we begin, a bit of housekeeping for today's session. This webinar is being recorded. All attendees will be in listen-only mode. Attendees are encouraged to submit questions for each panel using the Zoom chat function. We will reserve time at the end of each session for audience Q&A. Please keep in mind that this event is offered for general information and educational purposes only, and is not intended to constitute investment, legal, tax, or accounting advice. Any views or opinions expressed during this event are those of the participants and do not necessarily reflect the views of the Wall Street Blockchain Alliance or our participating firms. And now we'll turn it over to the chair of the Wall Street Blockchain Alliance, Mr. Ron Peralta. Ron, over to you.
Mute. Let me take myself off mute this time. Thanks, Candace, so much. Really appreciate you all being here. We've got a great panel. Thank you all for joining us for the last event of the WSBA year, aside from the holiday party next week, and hopefully some of you can join us as well. So let's dive right into it. I want to kick off with panel number one, which is really going to talk about audit expectations for companies that are conducting crypto reporting business. We've got a great panel in the lineup. It's a deep topic. There's a lot to talk about here. So I want to do quick introductions as well. Rod, why don't we start with you? Tell us about yourself. Tell the audience where you're from. You're on mute, buddy.
Great, Ron. Thank you. And it's great to be here, this opportunity to meet with this group. So I am an advisor to Luca, which is a data and software company in the crypto space and the blockchain space. I also am an educator. I teach advanced auditing and information technology in the MBA program at Rutgers. And I'm involved in a lot of research around this whole topic of accounting and auditing for blockchain.
Rod, thanks. Joey, let's move over to you.
Yeah, hi, thanks, Ron. Glad to be here. I am the current CFO at TrustSwap. We're a DeFi platform for individuals and businesses, providing tools for those businesses and individuals to operate in the DeFi space. And I also am a co-founder of Gilded Finance. We're providing accounting and invoicing and payment tools for crypto businesses using crypto. I've also been in the public accounting space. I spent 10 years in public accounting as a financial statement auditor, working for EY and RSM prior to kind of getting involved in the crypto space. So you'll get both sides of the paper here, both sides of the wall here, being a financial statement auditor in my past life and also now kind of working in industry.
We have our notes, Joey, believe me, we'll talk about both sides of that. Matt, how about yourself? Let's move over to you.
I appreciate the invite. So, I'm a partner in Crow's national office. I specifically within our national office, I focus on kind of the intersection of complex accounting and regulation. I also do a lot of the different strategy and innovation items for Crow. I wear other hats. I also sit on the Center for Audit Quality's Emerging Technology Task Force, and I'm the co-chair of the AICPA's Digital Asset Working Group, which for the last 3 or so years has been writing a lot of accounting and auditing guidance focused on this space. So appreciate the opportunity.
Great to have you here, Matt. And Jagruti, let's round out with you, and then we'll kick off some of our questions in the conversation.
Okay, good afternoon, everyone. I'm Jacqueline Salanka. I'm a CFO at BitPay. We are a crypto payment processing company based in Atlanta, process about $1 billion worth of transaction on an annual basis. Prior to joining BitPay, I was an audit partner at a top tier CPA firm and was with the company about 12 years. So like Joey, I think I can speak to both sides of the world. I guess I can safely call myself a recovering auditor. So yeah, now been in the crypto space for several years and very excited and passionate about blockchain and crypto and the direction it's going. So thank you, Ron, for having me here.
Thank you, Jagruti. So you are all WSBA members. Again, it's a privilege to have you. Let's dive right into this when we're talking about companies that are in the crypto business and kind of this idea of a reporting entity. And I want to level set with that kind of definition. A reporting entity, which really has an obligation to prepare financials for interested third parties. And I'm probably mangling that kind of definition. You're all accountants, but I want to start with that foundation. What types of firms are we talking about? For those of us in the crypto space for a long time, like most of us, a lot of those folks didn't know that they needed to prepare those. But now as crypto seeps more and more into the corporate world and the enterprise world. That's changing. Matt, let's start with you. What are these reporting entities? What are these types of companies?
I mean, most really, you've got all sorts of different companies that could end up with requirements or desires to do financials. And so, I mean, largely, starting out, we're non-public, right? Non-public companies. But there are public companies. Obviously, I think early, lots of different investment funds, were involved. We're starting to see more and more, traditionally commercial entities. Could be exchanges or custodians, could be money transmitter, payment processors, special purpose banks and trusts, mining companies. We're starting to see different types of banks interact with different applications of digital assets and crypto as well. And so, and in those banks, several of them are public companies. And you've got, the public companies that everybody's aware of as well, the MicroStrategy, Square, PayPal, Marathon Digital, like Hut 8, alike. And so, pretty good span of different types of activities they could be doing, the ways that they're interacting, whether it's, on or off balance sheet and alike. So that, definitely impacts the ways that you might go about auditing. So.
Matt, thanks. Rod, I want to switch over to you. You and I have been in this space for a long time and have collaborated on a bunch of projects that we'll talk about a bit later. You've been at Luca for a long time. Luca has been one of the main providers in this space for quite a while with others. What are you seeing? What are those companies? What are those clients? And I would almost ask also, what's the demand going forward? What companies do you see might be added to this kind of roster of reporting entities?
I think Matt covered it really well. It's a plethora of a lot of companies coming in this space. In addition to what he mentioned, maybe family offices, high net worth individuals, and now with the advent of NFTs and DeFi and other things, you have a whole nother group of people coming in. And as we get to tokenization, more tokenization, I think we're going to see even more. I think, Ron, the big issue for 2021 is materiality of transactions. Heretofore, it's been kind of a sandbox. It's been an emerging technology. And now what we're seeing at Luca and everyone's seeing is that these transactions, the materiality of these transactions, whether private or public companies, is significant. And there's people out there now that, 2021 is the year of materiality. There's people out there now that have to do reporting, and they have to do it now, and they're looking for help now for auditing, reporting, tax, et cetera. So I think we're seeing just about everybody getting into this space in one form or another. And I think it's incumbent on us to try and at least provide some pathway for folks going forward here that because now it's material. Now you have to do some. It's not your sandbox anymore.
Right. Thank you, Rod. Jagruti, I want to move to you because you and I have been in this space for a long time as well. And I remember you and I paneling. We've been to several AICPA blockchain symposiums, which we're privileged partners with AICPA. And I think when you and I first started talking about this, Bitcoin was a $200 billion market. And now the entirety of crypto is approaching over 2.5 trillion, depending on the day and the volatility. How has the landscape changed? And again, you've played on both sides of the fence. What are your thoughts on that evolving landscape? And what should we be looking forward to 2022 and beyond?
Yeah, no, a great question. So, one of the things, when I look at just the whole crypto industry and how it's evolved in just the past 10 years, right? And BitPay, by the way, has been around 10 years. And, a lot of this is coming also from what we are hearing within the company. It's almost like the first 10 years we saw companies or people kind of asking the question on why crypto, and then should they consider crypto? There was a lot more skepticism around the whole crypto space or digital asset space, or even understanding, whether or if blockchain is needed at all, right, for processes, et cetera. But now the dialogue has changed. I mean, in fact, I would say probably mid last year, we are seeing conversations that are more sophisticated, companies now looking to find a way to get into crypto. It could be something as easy as crypto for treasury, which, starting with MicroStrategy leading the path and building Bitcoin on their balance sheet, and they recently just bought a huge chunk again. But companies like that now looking at ways or creative ways to not just kind of dabble in crypto for speculative purposes, but more real reasons like treasury, having crypto for payments, In fact, we are seeing a lot more companies now, enterprise companies, traditional companies who are not in crypto space, looking to offer crypto as a way of payment and accepting payment and open up to a whole new market space altogether. So we are seeing more dialogue and serious conversations around how can they start processing or kind of getting in the crypto space and not missing out on these opportunities. So clearly a lot more sophistication, and even considering from my prior gig as an auditor, I think the one thing I saw that evolved over time was the sophistication of these companies. Like the whole ICO bubble that I guess existed years back, I don't think that exists anymore. I mean, companies are now, they're just a lot more sophisticated roadmap on what they're really looking to do in the crypto space.
Really good points, Shagriti, and thank you. Joey, I want to move to you as well. Again, you also have played on both sides of the sandbox, so to speak. And it's funny, I think all of us remember conversations with colleagues that are in crypto or blockchain, and we'd say things like, well, you need to think about reporting, you need to think about an audit, and no idea what we were talking about. And I think one of the things I want to start diving into at a more granular level, and Joey, let's start with you and Matt. I know you and I have had some conversations about this. What's that starting point for those firms involved and need to be involved in crypto reporting and audit? What are the things they need to be focused on? And I would almost argue, what are the basics? What's that first question they need to ask? Who's the first person they need to call?
Yeah, that's a great question, right? So if you're talking about the firm angle, and I'm sure Matthew can definitely chime in some more on this, but from what I was, in my prior auditor days, it's super important to get your arms around completeness, right? I mean, that's area number one, is determining, okay, if you are transacting, if the company you're performing an audit or review or doing some year-end or month-end accounting for, bookkeeping for, you need to get your arms around, okay, what are they using? Are they using a centralized exchange? Are they using, did they set up a hot wallet through Metamask or through some of the other kind of wallet providers, right? And just understand what's their current process that they're using crypto for. Are they using it for payments? Are they using it for treasury? Get your arms around the internal control, understanding, and processes and procedures first and foremost, right? That's going to be kind of number one, to understand kind of management's purpose around why they're I'd say using crypto, what their ultimate goal with crypto is, and then how that's going to evolve on their balance sheet and income statement going forward. If they're going to be using it more and more for payments, getting into it for treasury, et cetera, other reasons, but getting that initial understanding is obviously going to be the most, I'd say important aspect of kind of jumping right in. I mean, that's kind of, I'd say, like some basic stuff, like, any auditor should get an understanding of any process, but it's actually, with crypto, it's just super important, especially since the custody and control of potential wallets that are not on a centralized exchange where you're doing KYC, if you're setting up a MetaMask or some other type of wallet where there is no KYC involved, understanding who has access to those keys, who has access to the private seed phrase, how is that custody and division and control set about, that's super important as well. Obviously there can be some, immediate, if you want to say, like fraud scams or fraud alerts if there's not proper policies and procedures set up within the organization around who has custody and control of those assets.
Joey, before we move to Matt, I just want to, for the benefit of the audience, and most of the audience are professionals in the accounting, legal, and beyond. You mentioned MetaMask. For those who may not know, can you give a brief 10 seconds on what MetaMask is? And then Matt would love to get even more granular, peel back the layers on some of the comments as well.
Yeah, so when I'm talking about MetaMask, it's basically just a wallet browser extension. So when you set up a crypto wallet, you can do there's two ways to do it. You can go to Coinbase and set up an actual account. It's very similar to basically setting up a bank account. You have to go through KYC procedures, give your ID, give your address information, business ID, all of that, provide all that documentation so that you can then transact on the Coinbase and buy and sell crypto and transact on the Coinbase exchange. That's kind of more the traditional method that everybody's familiar with from the traditional finance world. Now in the kind of DeFi sector, there's if you want to say, decentralized trading platforms. Uniswap on Ethereum is the biggest one that hopefully some people have heard of. Basically, if you set up a browser extension wallet, so a wallet is just a seed phrase of numbers and letters. If you set that up, you basically, it's literally 2 clicks. It goes right into your browser and you have literally your crypto wallet. You can then link that wallet right in Uniswap and start buying and selling crypto right through Uniswap. Now, the only difference is you can't on-ramp using a MetaMask. On-ramp meaning you can't basically take your US dollars or Canadian dollars or euros and buy Bitcoin. you have to already have some Bitcoin or Ethereum, but then you can start interacting with some of these decentralized platforms and trading through these platforms. Again, doing that, there's no KYC or identification record of who you transacted with through the centralized platform. The only record is your blockchain transaction that actually occurs. So if you start diving into that, Etherscan and these other blockchain scan platforms are going to be your best friend.
Joey, thanks so much. And Matt, I want to come and appreciate that. We're probably going to do a separate Etherscan session at some point. Matt, let's come back to you on that question, kind of the where do they start? And let's get really granular on some of these things, because one of the conversations is there are challenges to some of the data and information that they need. But Matt, let's continue that conversation.
I mean, I guess, I might start with like a really simple kind of approach or kind of fundamental approach and just say, it starts with understanding kind of, what are you transacting in and how are you transacting? Joey ran through kind of the two basics, and I would say, what he was referencing is, one is on blockchain and one is off blockchain, right? And, depending on whether you're on blockchain or you're off blockchain and, different types of coins and tokens that you might be involved in, I would say, all the normal things of an audit apply, right? When you're thinking about auditing financial statements and, okay, well, I'm taking the financial statements back to the general ledger, and subledgers and underlying support and audit evidence. And, everything starts with kind of that auditor assessing the risk and then focus on obtaining the appropriate audit evidence based on their judgments about the risk to kind of tie out the underlying audit assertions. And, Joey mentioned completeness as one. You've got existence, rights and obligations, valuation, that everybody who's got an audit background is familiar with and heard of. And they want to start with understanding some of those controls. I mean, Joey talked about like differences in different types of wallets and which wallets have different types of controls and which things have different AML KYC, and that can present a number of different types of risks. Like, do you know the parties you're transacting with? Do I have, as an auditor, various related party concerns and things that I need to get at with just knowing the parties that you're transacting with? And then you've got wallet generation controls. Joey talked a little bit about, wallet generation and, who's able to access the wallet, who's able to generate those wallets, like what are your controls over, who's able to do that and the completeness of those different types of items. Then you start getting into, once you get beyond controls, you start to focus on, the substantive testing, right? You're not always able to get controls reliance, or it may just not be, as efficient, for things that you might just be able to pull all of the transaction activity and test all of it, depending on the materiality, your judgment of risk, and other items. And so I think when you start to think about the business, things split almost immediately, right? The on and off chain items, right? And when I say off chain, Joey's like, oh, well, we're using Coinbase, right? And well, Coinbase is maintaining your wallet for you. They're maintaining kind of their own internal records of who has what, like as they move those things around between, owing Matt a certain number of coins and tokens or owing Joey a certain number of coins and tokens. That's all off blockchain. They're not posting every single transaction that they do between their customers, to the blockchain. That's when you start to need, well, they're a service provider, right? You're relying on their controls and their ability to do those different types of items. I mean, you can have other things that are off chain, but that's just an example, right? You could have side chains, you could have any number of different types of things as well. And so, I think you start with saying, okay, well, I've got these off-chain items. I'm going to need to get SOC reports. I'm going to need to, if there aren't SOC reports available, I might need to like do different types of procedures where I'm either going to move assets to a location that's covered by the SOC, or if I have on-chain items, I'm gonna, and I'm doing self-custody, I might need to do different types of procedures, be it, challenge transfers using memo fields, doing different signature verification or encrypted message signing, and other procedures to kind of build that level of evidence. So, I mean, there's a lot involved as you kind of like start to break down those different types of items. But I think, those are some of the basics that, that I think about as I sort them out.
Yeah, and there's a lot there, Matt, and thanks for that. And Jacqueline, Matt and Joey gave us quite a bit. I want to turn to you a little bit, and Joey, certainly feel free to chime in again, because you've got these dual perspectives. What are the challenges to even address some of the stuff that Matt's talking about for these reporting entities? And I almost want to put it from the perspective of reporting entities that are newly reporting entities or didn't understand the implications of the reporting that they have to do maybe a year or two ago. What are some of the challenges for them? How might they address it? Jacqueline, let's start with you.
Yeah, I think, we just heard Matt kind of talk about SOC reporting, internal controls, bunch of stuff that auditors are typically looking for, right? And it kind of goes back to, does the company that is getting audited or, reporting, do they have any of those documents to provide the auditors or external parties to look at, right? So it kind of goes back to having proper documentation and analysis done on literally any significant process that touches crypto. And I think that's where really, back in my prior days as an auditor, I saw companies struggle with that a lot. And one of the primary reasons was because we are dealing with finance people on the company side. And typically, finance people are not, you're good enough with the whole crypto side, but not technically there, right? We just can never be, a technical geek, so to speak. Bridging that gap between here is what a finance person understands based on crunching numbers, et cetera, documenting policies, et cetera, right? And getting the technology guys from the company looped in to build a comprehensive roadmap of identifying what your key processes are, what are your key controls, what are your risks around each one of these processes that you identified, and connect them to all the 5 audit assertions, and then find a mitigating risk aspect to each one of these items. I think documenting that entire framework before another party can even look at it, I think that's the biggest challenge. And I'll be honest, I'm having to do that right now at BitPay, kind of put together, what I'm going to call a ICFR framework, internal control reporting assessment framework, that we are having to submit a regulatory body for licensing purpose. And that's something, private companies are not used to doing. It's a relatively, new requirement that we are now seeing, companies having to do. And we are not used to it. Public companies are, because of just the thresholds they need, but private companies are not. So again, it kind of goes back to documenting, how we as management understand the entity, what are our controls, and how we can get external parties comfortable with some of these risk areas that we see.
Grudy, thanks. And Joe, before we go to you, for the audience who's participating, we've seen some questions come in. Please continue to submit your questions via the Q&A. We've had a couple of chat questions as well. We'll address them in the last few minutes of this session as well. But Joey, is there anything you want to add to that, to Grudy's comments?
She pretty much hit the nail on the head. Here at TrustSwap, I'm dealing with a lot of the similar issues, not as much on that scale. We're still a new company, only a year and a half old. We are having a significant amount of crypto transactions. I'd say 98% of what we transact in as a business is in crypto. So getting, as Jagruti said, getting the proper kind of processes and procedures in place to meet these kind of regulatory guidelines and standards that you need in order to be able to, if it's getting certain licenses for custody and security licenses if needed, et cetera, going forward, any sort of licensure that's needed for regulation, not just in the US, but in globally, right? Because crypto kind of opens up the world to global transactions, global payments, et cetera. So kind of dealing with the kind of, if you want to say, the international and global regulatory side of things, as well as kind of the US regulations, and just getting up to speed, right? Making sure you have all the right data complete and accurate, that's being input kind of into the financial accounting system, financial software to kind of create that rolling data. So like I said, Jagruti really hit the nail on the head, but just adding to the fact of kind of the regulatory, meeting those regulatory standards that private companies are not used to, is definitely a challenge in itself.
Joey, thanks. Rod, I want to pivot to you a little bit. And you and I had the opportunity, I had the privilege of working with you and other colleagues on the AICPA ISAC, our blockchain risks document. You and I had also worked with other authors on the blockchain framework that came out last year as well. Let's dive into the controls a little bit. What are your thoughts on what needs to be included again, bolting a little bit on what Jacqueline and Matt and Richo are talking about, what do they need to be thinking about from that controls perspective that we've alluded to here? You're on mute, buddy.
Thanks, Ron. One of the best kept secrets in the auditing blockchain space is that there is some real good tools out there for firms and practitioners to use. And about 4 years ago, we started a research project working on asking the famous auditing question, what could go wrong? Looking at objectives, risks, assertions, and controls. And we suddenly realized that in the blockchain space, especially the blockchain itself, that there's many things that don't even apply to a traditional control environment. So for example, there's no archiving in blockchain really. There's no data center. The access controls are very different with key management versus passwords, et cetera. So we came up with a bunch of controls in this research project with PhD students and others. And we open sourced that to the ICPA and to ISACA, and we formed this group that you participated in a dream team of other people. And we went through and developed a very granular, very specific set of risks and controls to address in the blockchain crypto space. And I admonish everyone to go to their respective websites, ICPA and ISACA, and pull these documents down, because again, no one knows they're there really. Even and the ICPA is struggling with how do we get this word out more. But they cover 5 domains. They cover governance, they cover infrastructure, which is protocol, code or protocols, consensus mechanisms. They cover data, which we're doing okay on data. We're auditing data, but we're not auditing the IT general controls very well on blockchains and the ecosystem itself. Key management, which is another one. And then probably the biggest risk in blockchain is smart contracts. And we've learned a lot through things that have gone wrong with smart contracts. And there are ways with ubiquitous controls to audit smart contracts. I'm a big advocate of the SOC, because I think we need to have SOCs for everybody in the space, and particularly need to start asking the question, how do we provide SOCs for public and private blockchains themselves? Because they are clearly significant financial systems with blockchains and smart contracts within this space. But I just admonish you to get that document and look at it. It'll take you through what you ought to be looking at for internal controls, and for firms, what you ought to be auditing in this space.
We have been appropriately admonished, Rod. I appreciate that. And you brought up SOC, and I kind of want, there's so much we could talk about here, but I do want to dive into the SOC, and I want to be cognizant of time. And again, for the audience, please continue to submit your questions via Q&A, please. Matt, let's move to you on the SOC stuff. Let's talk a little bit about what are those expectations of a reporting entity, particularly if they've never even heard of SOC before. And we've got no shortage of colleagues in the space who have continued to email you and I and say, what, SOC, what is that? And what are the challenges? What do they need to address? How do they prepare?
Yeah, so I think just like getting audits is new in the crypto industry, I think SOCs are kind of a new for service providers, right? I mean, you roll back a couple of years and nobody got a SOC. You talk to people. I mean, even this last year, I'd talk to somebody and they'd say, "Oh, well, you're going to need to get a SOC. You're going to get asked for a SOC." And no, I'm fine. We've got all this stuff where we got a really great name, like everybody uses us, and like sure enough, now what do we hear? Oh, I need to get a SOC, right? I mean, it's just kind of what's expected if you're a service provider in the U.S. And you're trying to be able to get your companies that are using your software or using you as a custodian or whatever, that you're really trying to get them that level of assurance that they need to use you in an audit. So, I think, the expectation now really is that, companies being audited should expect that their audit firms are going to ask them for SOCs on their significant systems and service providers that impact financial reporting, right? And so, first you've got, 2 different types of SOC. You got SOC 1, which is controls over financial reporting, right? And then you have a SOC 2, which is really, kind of the security, confidentiality, and availability, right? And then you've got, SOC 1 type 1, SOC 1 type 2, and this really gets down to, kind of a point in time report versus a kind of a period of time covering over time. But, what companies that are getting audited are going to expect their audit firms are going to expect them to have done with it is obviously first get the SOC, right? You're going to need to request these for significant systems and service providers, but then you need to review it for the scope of what the report covers, right? What's needed. Does it cover all the relevant systems and services you think it covers? For example, if it's exchange, is it exchanges of the custody products that you use, or is it other products within their suite of services, right? Ensuring that the description of systems matches kind of the controls that are identified and tested. So there's a whole section kind of initially in the front that talks about description of systems. There's a separate section that really talks about kind of the controls that are tested. And the point of really is to like match those up, right? And make sure that you review those. And I think the last thing that I would say is, kind of when they get a SOC the first time, the SOCs are all new. This isn't like reviewing ADP or something like that, who's had SOCs forever and it's pretty well, understood. You need to pay special attention to like carve outs and subservice providers, and determine what things are significant. What things that they're also going to have to go get and obtain. You might have you might be relying on other different types of things like Amazon Web Services or or other providers that you're going to need to, understand. You need to go track down other information. So, but that's the basics of, what you're getting and what you need to do with it. There's a lot more to impact.
Yep. And Matt, thanks for that. And I know I'm grateful that you're moderating panel number 2, which kind of dives into the SOC stuff in a bit more detail as well. I think the core of a lot of the conversations that all of us on this panel have had is really around data. And we've talked about non-normalized data. We've talked about the challenges of even sourcing the data. Joey, I want to start with you, and then I want to move through the entirety of the panel because I think we've all hit this a little bit. What are those challenges, and those challenges going away from a normal data perspective, from a price and valuation perspective? What are your thoughts there?
Yeah, I mean, when you're talking about, and sorry, I missed the first part of your question. My internet was going in and out. But can you repeat the first part? You're talking about price evaluation.
Yeah, just the challenges of analyzing data, sourcing data, normalizing data. Matt and several others raised multiple exchanges. And I remember in the early days, they were publishing different prices. They were publishing prices on different, different cadences. So if you could dive into that a little bit for preparers, that'd be great for reporting.
Yeah, absolutely. I mean, that's definitely a huge challenge, understanding exactly where the data and pricing is coming from. From my end, from my perspective, especially being a reporting entity, I stick with one pricing method, one pricing source, and stick with that. That kind of goes back to the old audit methodology of, pick a method and stick with it. As long as you don't change, if there's no issues with the method that you're choosing necessarily, typically you're okay until further guidance or further kind of regulation comes about. So kind of sticking with one pricing data source for a company, the size of ours right now and the regulatory and reporting requirements that we currently have works for us. But it is a challenge, and I'm sure Jacqueline and larger enterprise corporations have that challenge, which is partly what Luca is helping to solve, but have that challenge of getting the proper valuation and pricing methodologies and getting the proper data valuation methodologies, if you want to use that kind of term, around kind of properly disclosing reporting and reporting those transactions on your balance sheet and your income statement.
Joey, thanks. And I know in the prep and in some of the documentation we put together, we wanted to dive into staking and DeFi, and I feel that's a pretty deep rabbit hole that will require to have an entirely separate session on. But I want to give Jacqueline an opportunity, if I could speak to this. Your observations as a preparer of these items broadly. Anything you want to highlight, or what are those first highlights for participants that may need to, reporting entities that may need to focus on some of these things? What are your kind of recommendations? And then I want to open that up to the rest of the panel as well.
Yeah, so I guess, kind of broadly speaking, I guess a couple of things. I think we all covered pretty much everything. I think, some key takeaways would be documentation and analysis, super important, right? Not just for processes, but also controls and connecting all the dots from a technical operational side, which then ultimately boils down to financial side, right? I think that piece is critical. I mean, it's almost like part of your month-end close. You just almost got to do that, and make a habit of that. And when it comes to documentation, right, it's the internal controls, it's valuation approach, right? When we talk about valuation, Joey, you kind of touched on it, but determining who is your principal market. Does your principal market change? And if so, why? If you're trading in, if you have thinly traded crypto assets, or, you have staked assets or crypto assets with liquidity restrictions, all of those attributes of those crypto assets need to be understood really well, so you can document what your valuation approach or policy is going to be. And after you're done with all this documentation, I think getting auditor approval before closing your books, or at least closing your year end, super important, so you don't have material adjustments or surprises after the year. I think that is critical. The other thing I would say is preparing technical analysis or technical memos or white papers, whatever that might be, on technical accounting matters. It could be something as simple as, we treat crypto assets as intangible, and here is what our impairment policy or process is, and here is how we track. That's one key thing that I would imagine every company in having crypto will need to document. Documentation of ASC 606, revenue recognition impact of crypto transactions. If you have crypto where you are investing in, say, liquidity pools or DeFi platforms, I mean, those are complicated investment strategies, and documenting your accounting analysis, your tax impact for all of these strategies, I mean, kind of goes back to documentation and analysis, and just long papers of writing up stuff.
Yeah, and just to piggyback real quick on one thing that Jagruti mentioned when you're talking about any specific crypto asset and where it can be traded. A great example is our token. So our company has a token, the TrustSwap token. And if you go on CoinMarketCap or CoinGecko and look at the markets that we trade on, we're on about 10 different markets. We're on 5 or 6 different DeFi exchanges, and then a few centralized exchanges. And you'll see the liquidity, trading volume, and the price difference on each, right? So if you're an auditor and you're looking at this, you're like, well, how am I supposed to know what the, if they're transacting using their own token, or that token's being bought and sold, or the company's transacting using it for payments, how am I supposed to know what the fair value at the spot price at the point in time of the transaction occurs when I'm having multiple different data inputs from multiple different exchanges, both DeFi exchanges and centralized exchanges? So again, that rabbit hole of itself is definitely probably a separate discussion, but it's important to if you want to say, get that into your or understand that and put that into your auditing and accounting or auditing considerations for year end for that company, to determine which pricing method and which valuation method you're going to be using.
Yep. Joey, thank you. And like every good panel, we're running behind, and we could probably go for another hour. So I do want to hit up some of the Q&A that we've got. Any questions, folks in the audience, that we don't get a chance to answer, please email us. We're happy to reach out. Matt, I actually want to kick off with you. John submitted a great question. We'll hit some of the others as well. What are the challenges you face in your firm related to the lack of education in crypto and blockchain as it relates to staff? It's an interesting question. We get this a lot. What's the internal challenges? And let's have this conversation for all of you. But Matt, what are your thoughts there?
I mean, there's a lot of forces going on this. One, I would say his point about, there's not a huge percentage of CPAs that start out just instantly knowing this. There is a learning curve for everybody, right? Picking this stuff up the first time. In the kind of great resignation, there's a lot of turnover, and it takes time to get people back up as well. And so I would say, what you largely see is most firms, have a group of folks that are focused on this, and they're working very hard to, kind of build that pipeline up, build education, provide different types of resources so that they can develop people, and kind of turn, maybe you start with 8 people and you turn it into 24 people. And, what are you doing to do that through training, allowing them to, work on different types of audits or do different types of things in the off season to reperform different types of items, do different self-studies. The AICPA and WSBA, I believe, worked on a number of different types of trainings that I think, a lot of people find those very helpful. So, those are the different types of things. But yeah, it is a challenge. It's not just a challenge for the firms, though. I mean, it's a challenge for the companies as well. So.
Appreciate it, Matt. Thank you. And again, I want to hit a few more questions. Apologies that we're running late. We'll hit these questions later on by email as well. Brett asked a really great question. I want to open up to the panel. Let's keep it brief if we can. Can we discuss the importance of an entity evaluating whether the tokens in their hosted wallet are actually recognized as digital assets versus the promise to deliver an amount? Can either of you speak to that? What are your thoughts about that? Any of you speak to that?
I'm happy to jump in. Yeah, I mean, it's a super important question. The best resource that I'm aware of is question 10 in the AICPA's Digital Asset Working Guide. It goes through a number of different factors, in the context of a custodial arrangement. So, you have somebody else holding your crypto for you, but that can be, third-party hosted wallet arrangements, and starts with legal, then goes through control concepts in accounting, and outlines about a page of different factors, thinking about things like commingled wallets and side agreements and any number of different types of things that that will be your typical question and answer. I would say that my experience is those questions line up pretty consistently. A lot of different firms use that information to go through the analysis, do the write-ups, and a lot of them are very similar to the types of questions you would get on the topic from the SEC or others.
Matt, great. Last question that we're going to put out there, and I realize we're up on time, and I want to throw this to Joey first. I suspect we all have a distinct answer on it, but what are the reporting requirements for assets that are only traded on DeFi exchanges? Joey, I will be very impressed if you can give us a 10-second answer to this.
Yeah, I mean, so, okay, 10-second answer is going to be that you need to, if you're talking in the US, you need to make sure, long story short is keep all of or make sure you understand how the transaction occurred, find out, basically find the transaction on the blockchain. B, typical like of any other transaction, you need to understand payment to, from, etc. But if you're talking about reporting requirements and financial reporting requirements, there are specific disclosures, and that's on a country by country basis. I won't dive into those, but there are specific disclosures that we didn't even touch on, kind of financial reporting disclosures here, but there's definitely disclosures, but put that in your considerations for DeFi transaction disclosures.
Next year's workshop, every panel will be 2 hours. No, I'm totally joking. We're going to leave it there. We're run up on time. Everyone, Rod, Matt, Jagruti, Joey, thank you so much for your expertise. Anyone who's in the audience has additional questions, or if we missed your question, info@wsba.co. Thank you all. We're going to take a brief break. Matt, you're the moderator for our next session. We really appreciate it. And we'll be back in a couple of moments. All right, we are back. I know that was a bit of a short break. Matt, Michelle, Jacqueline, Rich, hopefully you can hear us all. Matt, I am going to turn session number 2 over to you, preparing for your first SOC report. Thanks for moderating. Thank you for all being here. Over to you, Matt.
I appreciate it, Ron. And so maybe we'll start off real quick with background and introductions for everybody on this panel. So this panel is focused on service providers and people that are getting their first SOC report. We talked a little bit about SOCs on the first panel and first session, but this is really from a different perspective. And so I think we've got a great panel lined up of folks with experience with SOCs for many years, as well as experience doing SOCs for crypto and blockchain companies. And so maybe we'll start off first with Michelle. Do you want to give a quick introduction?
Sure. Thanks, Matt. A pleasure to join today. I'm Michelle Chopper. I'm with Cohen and Company, which is one of the top 50 firms in the country. And we have a designated digital asset practice, which provides a variety of services to the cryptocurrency and digital asset space. Myself, I lead our risk assurance and advisory practice, which focuses primarily on internal controls, SOC reporting, risk management for clients, including those within the crypto space.
Thank you very much for joining. Jacqueline, you want to go next?
Yeah. So, hey, everyone. My name is Jacqueline Dutloff. I'm a senior manager in Crow's IT assurance practice, based out of Los Angeles after maybe a strategic move from the Midwest, especially this time of year. I work with clients in mainly financial services and technology companies on different types of IT control audits, probably similar to Michelle's areas of focus, just different acronyms at different firms, but SOC reporting being a main area of specialization.
Awesome. Thanks, Jacqueline. Rich, you want to go? Last but not least.
Hey, hi, everybody. Rich Peralou. I am with Crow as well. I'm a partner in the IT assurance group. We focus on a number of areas, one being SOC, and another, I focus some time on IT controls within external audits for financial statements. So I've been doing this about 20 years, also in Los Angeles, and happy to be here.
Awesome. Appreciate you all joining. So maybe we'll just go ahead and get this kicked off. So I guess maybe for people that are not familiar with SOC reports, we do a little bit deeper dive on what a SOC report is, the relevance of a SOC report, kind of specifically in the crypto asset space. And maybe Jacqueline, you can start. So.
Yeah, of course. I think in order to explain what a SOC report is, maybe I'll start with what types of companies would need them, and then lead into what a SOC report is, maybe create a bit of suspense. But so I think to start, not all companies will need a SOC report in the way that some other types of audits are required, based on a regulation where you have to go through this audit to show you're in compliance, or otherwise, someone's going to throw a fine at you. SOC reports are ultimately more of a business development strategy and making your customers happy. Service providers will go through SOC exams, really for the benefit of their customers, because they're asking for SOC reports, which we'll get into why in a second. And this, in addition to benefiting the customers, also benefits the service providers as well. They can now go to market with the SOC report in hand to demonstrate that they take internal control seriously, they have really solid practices, and are doing the right things to protect their customers' data. Maybe one quick thing, I'm sure throughout the panel we might use slightly different terminology. So if we say service provider, service organization, third-party vendor, all referring to companies that would issue the SOC 1 or SOC 2 report to their customers. So just continuing that, a SOC report is something for companies whose customers are other companies, other businesses. If it's more of a retail direct-to-consumer type of model where customers are individuals like you and me, typically we wouldn't see SOC reports being asked for there, just because individuals don't usually know to ask for them, or it's not something that's really as much of an important need. So if you think about service providers that are providing those services to other businesses, typically one or all of the following is true. The service provider is developing and managing, maybe hosting key application systems. They may be performing key business processes on behalf of their customers, so more of an outsourced services model. So because of one or both of those things, they have a lot of sensitive data. It might be data about their customers or about their customers' customers, sensitive personal information and things like that. So in that type of situation, the customers don't have a lot of direct insight into what that service provider is doing. how they're protecting their data, managing their IT environment, performing some of those business processes or transactions on their behalf. So I mean, they can, maybe in the old days they can trust that they picked, a good provider with a good name and just assume that they're doing the right things. Sometimes they'll give out detailed questionnaires and they'll say, please describe, your information security program. Please describe XYZ. Please give us copies of all your policies. But they're really moving away from that to SOC reporting, over the last 10, 20 years, because it is a much more efficient way for service providers to go through an independent audit once that's scoped based on the services they provide to customers, the things that their customers will care about, and then to be able to hand out that report and not have to do, so many questionnaires and individual audits and that sort of thing. So it really has a lot of benefits, to the alternatives that have existed before. And then I was gonna say just one final point. I know I talked mainly about service providers doing SOC reports because their customers are requiring it, which is true most of the time. Something we also see though, especially with newer startup type companies, they may go through a SOC exam and get a SOC report proactively because maybe customers aren't asking for it yet, but they know that the requests are coming. And it is a way to, again, present with a little bit more credibility to maybe differentiate yourself from your peers and show that you have those mature processes in place and you're doing all the right things to protect data.
Yeah, I'll just add quickly that kind of add to it what Jacqueline was saying. Where we're seeing the types of companies are typically your software vendors. These are companies who have designed and developed their own tools that are pulling data off the blockchain, performing some level of analysis and reporting. And as you heard a little bit on panel one, custodians, exchanges, those are typically the companies that we're seeing at the moment.
I'll jump in real quick too, Matt. As you said, cryptocurrency exchanges, funds themselves, brokerages, trading platforms, wallets, and other service providers. Pretty much any business that has grown up within the crypto space is storing sensitive information, and probably the most sensitive of which is customers' private keys to their cryptocurrency holdings. So because of that, there's actually been a lot more traction for SOC reporting within the crypto space than we've seen in some of the other industries. On top of that, we've had a lot of significant large scale cryptocurrency hacks, scams, thefts, those sorts of things coming out of the woodwork in the past few years. So consumers aren't willing to place the same amount of trust in companies without some sort of third party verifying and providing external assurance. So I think all of those things are kind of what leads us to having a conversation like this today.
You have to say that dovetails into really some of the trends that we're starting to see in SOC reporting with crypto organizations. And so I guess, maybe, as you're looking at kind of this, taking hold, maybe, Rich, do you want to kind of, give some thoughts on, what we're seeing in those trends?
Yeah, it's interesting on the first panel, a lot of what was discussed in panel one relating to the need for audits and these new companies, and it's all very new. I'll say within the SOC world of auditing, it is early. Just like we're hearing with the typical audits, it's early in the stage. I would say it's not a mature service right now. So if you were to look at, how many SOC reports are being performed at the moment in the crypto space, it's they're not a lot. Now, we've been doing SOC reports for many, many, many years, but this is just something that we're seeing new for the first time. And if an organization has one, it was just in the past year, typically. Okay, there are exceptions, but typically in the past year. So a lot of this is very recent. But I will say it's gaining steam very quickly. It's turned a corner, and then all of a sudden, SOC reporting is the hot topic now, and we're having a conversation in the panel on it now, where it wasn't too long ago that it was mentioned and it was kind of brushed to the side. So that's kind of the 0 to 60 went pretty quickly and got to where we are right now. The two areas I would say that you have conversations related to SOC reporting or providing a service in the crypto space. So if you have an organization who is providing a service, again, whether it's a software tool or anything else, they are coming to the firms and asking for a SOC report. Okay, one of their clients or many of their clients are asking them for a SOC report. We're also seeing it on the external audit side, where we as a firm, or the firms are auditing an organization, and that organization has more recently gotten to the crypto space, whether maybe it's a bank and they are now using vendors that are custodians, and the custodians are involved in crypto or digital assets. So at that point, you have the audit firms asking the companies for the SOC report for these custodians or these other software vendors, which again weren't around until recently. So we're seeing it on both ends, I think is important. There are, and not to get into too much detail on this, but there are types of SOC reports. There's SOC 1 and SOC 2, but there's type 1 and type 2. I think the big trend now is we're seeing companies focus on the type 1s, which they are, it's a bit quicker to get to market. It's a point in time audit as opposed to a traditional SOC report, which is going to cover 6 months or more. We're seeing that. I guess the last thing, which I think is important, is emphasizing on the point that this is all fairly new to everybody. Okay, I'm seeing a lot of partnering and with client and firm, and what I mean by that is the clients are coming to the firm saying, I need a SOC. They're going to listen to panels like this and understand what is a SOC. Help me understand, what do I need? How much of it do I need? What's the scope? And then you have the firms really working with clients and understanding the specifics of the control environment within that specific client environment. And when you think about blockchain, you think about typical systems that are financial types of systems that have been around for a very long time. You have no systems that have been around a long time that are focused in processing crypto currencies and crypto assets, and the environments are different. Blockchain, does blockchain have a SOC report? No, blockchain doesn't have a SOC report. So there's all these factors, and I think what I know we're seeing is they're bridging a lot of that technology with a lot of manual processes right now to kind of keep everything together. So I think those are some of the trends that we're noticing, starting out.
I'll jump in with a couple more just to add to what Rich has shared. So one trend that we're seeing with specific, not just to the cryptocurrency space, but across any type of service organization that is seeking some sort of assurance over their internal controls. Two trends really. One is that they don't always understand or know all of the entities that they're touching, and they aren't very familiar with how to establish what the scope of their report's going to be. And so sometimes the SOC itself, having a SOC report itself, is not the actual solution or answer for them in the moment, because they may be outsourcing a fair amount of their operations and their processes. And those companies that they're outsourcing to may be the ones who ultimately should be getting the SOC. And so what this company needs is some other type of assurance or consulting engagement, which looks into that company, but doesn't necessarily, or is an engagement over the processes that they themselves have over monitoring that company, but it's not necessarily a SOC for them. So that's one thing that we're seeing. Another thing is that there's within the provider space, there is a number of firms that are now out there offering, basically you can be SOC compliant so quickly, like 6 weeks, you can be SOC compliant. We can get you a report, or we have tools for you that'll help you be SOC compliant really fast. A lot of those are really false promises of what they're capable of doing and what companies are really prepared to do. I think those companies can work if you have a well-established system and operation of your controls, and you have really good documentation and evidence of your controls already, and you have individuals within your firm or other types of consultants that are helping you to maintain compliance on an ongoing basis. However, if you don't have all of those things already, those types of service offerings that you're seeing out there are not going to ultimately get you to where you need to be audited by a public accounting company, a public accounting firm that can actually issue a SOC report on your behalf. They're really offering a tool that requires a tremendous amount of support from you to get it up and running and going. And if you aren't partnering with an accounting firm that's going to ultimately help you assess your risks, help you to build out your control environment and everything else, like you're going to have trouble going with that route if this is your first time attempting to achieve SOC compliance.
All good points. Maybe we'll kind of start to try to walk through the process of, when you first identify that you need to get a SOC report for all the different reasons you guys have discussed. What are really the next steps? And maybe, Jacqueline, we'll go back to you and you can, kind of take us through that.
Yeah, so I think if you have a customer or prospect that's asking for a SOC report, whether it be politely or if they're forcing the issue, or if it's something you've just identified internally as an initiative you want to work towards, there are, I know we've been throwing different terminology around. There's a few different types of SOC reports. So you want to think through which one should you work towards based on, what you do as an organization and what your customers who use those systems or those services are concerned about and want more insight into in terms of your operations and controls. The SOC 1, so it used to be called SAS 70 in case anyone hears that, or if that's still being written into contracts. That was around first, so it's been around since the early 90s. And that's what was really designed to address the ICFR, internal controls over financial reporting concerns. And that's from your customer's perspective. So not your own internal accounting records and financial reporting, but any financial transactions you're processing for your customers, the financial data that you're holding for your customers, what they would need to know and get comfortable over for their own external financial audit. The SOC 1 reports, again, they're used by your customers, but they'll often be also given to your customers' external auditors, so the CPA firms, public accounting firms, as part of their procedures. Generally speaking, I mean, it depends what each service provider is doing, but a SOC 1 tends to include, let's say, roughly half and half business process controls that are more focused on the day-to-day operations supporting the services that are being provided. And then it'll be half, IT technology controls. Tends to focus more on core processes, IT processes, like how you manage user access to the system, how you're doing software development and change management, things like that. One important thing, I mentioned that the SOC reports, SOC 1s came first. So sometimes you will just see, we want a SOC 1, we want a SOC 1. But if as a service provider, you don't have that financial data impact or connection. Maybe you have other types of sensitive data that's not financial in nature, but something else. And that's where SOC 2s come in. So they were created a little bit later just to address more broader sets of risk. You know, how are you securing your systems? How can we trust the integrity of the reports we get out of those systems? How are you protecting our confidential data? SOC 2s, because they have that broader focus, any service provider can do a SOC 2, whereas a SOC 1 is really only applicable if you have the financial data. In terms of choosing which report to do or which ones you might do, some organizations will start with one. If a SOC 1 applies, typically we see them start with the SOC 1 first, because it is more of that financial reporting, financial audit connection and need driving it. Organizations may choose to add a SOC 2 later, or sometimes we see them tackle them concurrently. They're like, we want to go through this readiness effort and this lift once. And there's usually about, let's say 30% overlap, don't quote me on that, but roughly, if you were to do a SOC 1 and SOC 2 at the same time, there would be some common controls to help with that.
Okay, so maybe moving into, when as service providers are seeking a firm to really partner with for SOC reporting, I guess what are some of the evaluation criteria they should keep in mind? And so maybe Michelle, you want to, kind of cover some of those?
Sure. So having experience, partnering with a firm that already has experience in providing SOC compliance and performing these types of engagements is important. It's going to be a key requirement. And in particular, whether they have that experience in the industry that you're positioned. It's also important to note that if you're going the route of a SOC 2, if that's the one that ultimately is going to make more sense to you, it's not just security related. So there's 33 criteria there, and 20 of those are related to the controls out of COSO, or the principles out of COSO, and related to risk mitigation. So having a service provider or an auditor that is understanding your risks is going to be critical to them being able to help you identify and assess risks that are going to affect the way that you're able to achieve your control objectives or achieve the principles of SOC 2 or SOC 1. So I think it's important to have a lot of conversations with your potential auditors about how they go about assessing risk and how they would go about working with you in identifying the control objectives and the controls that ultimately are appropriate for your organization. Some of the risks specific to blockchain and crypto, obviously there's infrastructure, development, operations, information security. There's also a lot of risks around smart contracts. So there's a lot of detailed assessment of risk that has to go into these types of reports. They need to understand the risks around cryptographic keys and consensus mechanisms and the protocols there. So having those conversations up front with them and having them be able to assist you in evaluating the impact of those things on your specific business is going to be important. And I'd highly recommend talking to them about that. The other part of it is what technology they may be using to help assist in having a streamlined and efficient execution of this engagement. You want to have something that isn't a really cumbersome and burdensome on you, while still maintaining appropriate independence from that third-party auditor. So those are some of the things that I would take into account in doing your evaluation of who you'd want to partner with.
Maybe I'll stay with you for a second as we, as you kind of think about a readiness assessment. We've talked about this a number of times where it's like you can't just jump in and do this right away. And so I guess, can you talk a little bit about what that looks like and if it's something that's really required? Michelle?
Sure. So readiness assessments are supposed to be designed to assist you in figuring out how prepared you are. Now that's whether you're SOC 1 or SOC 2. It's really walking through your processes and walking through your documentation and seeing and helping you identify what your key controls are. It's not necessarily a requirement, but it's highly recommended. In particular, in this space, if this is your first time and you don't necessarily have the in-house expertise, it's a good idea to undergo a readiness assessment first. Some of the things that the firm will help you do is during this assessment is identifying the boundaries of the system that you have, the scope of your report, helping if you're in a SOC 1 situation, then helping you determine what the appropriate control objectives are for the services that you're offering, helping you to draft the narrative description of your system and of those controls, not necessarily themselves putting the pen to paper in that drafting, but having ample amounts of technical guidance available to you, checklists and questionnaires that help you to formulate what those controls are. And really one of the key outcomes of the readiness assessment too is ensuring that you're identifying any significant gaps that may be present before you get to the point where a firm is coming in and doing the examination. And if there's gaps at that point, when they're doing that examination, you could have deficiencies that ultimately are going to get identified in your report. And that is not your end goal, right? You want to have a clean report, a clean opinion. So working with someone in advance to help you identify those gaps, offering recommendations for remediation in advance of that examination stage is important. So it's something that we, for most of our clients, they ultimately undergo a readiness assessment before that examination period.
Awesome. And so maybe as we think about a time frame from, say, readiness to final SOC report in hand, Rich, can you kind of talk to us about the timing that we'd be thinking about there?
Yeah, kind of piggybacking on what Michelle said, it really depends on how ready initially, use that word ready again, is the client. If you go into a client and you ask about certain controls over user access or controls over the development of their new system that is a proprietary system, maybe that was developed in-house, and they look at you with kind of a deer in the headlights, the readiness assessment is gonna take more time, not only to perform, but also it'll take more time typically for that client to put processes and put controls in place to even get to the point of being audit ready. So, and that really just depends on the client. That's a client by client, basis. Something else, it's interesting, a lot of these, especially in the crypto space, we're seeing a lot of these clients, they're moving 100 miles an hour. No one's just sitting around trying to find stuff to do at the client. Everyone is either creating or they're maintaining, they're doing something so it takes for a new company to do a SOC report, it takes time. And it takes resources from those individual companies. So it also depends on the availability of those resources at those companies. We've been in situations where we've had some people that have been very, that they bring in someone that understands SOC reports and they can help guide them. And sometimes we come in and no one knows anything about it, and the control environment is not very mature. And I would say the last thing is the type 1 or type 2. So a type 2 report is a SOC report. That's really what you want to get to. It covers a period of time. It's going to tell the companies that are using your product that, this 6-month period, this 12-month period, controls were effective. That also takes time, right? So if it's 6 months, you start your audit period, say on January 1st, and then you actually end it, just say if it's 6 months, you ended it in June, and then you're auditing soon after that. So that's a 6-month built-in time frame that you have to also consider. Some clients go with a type 1 report, which is a point in time. You can get it out a little bit quicker. it's a smaller hurdle, a lower hurdle to jump over basically, but it's a point in time. That's something we've seen clients do if they want to get a report out more quickly, but that's still after a readiness assessment. So I guess the answer is, in the audit world, it depends. Right.
Yeah, I'll throw out broad ranges for you. Readiness assessment from 2 months to 6 months generally is the average that we're seeing. Your type 1 examination, which would follow, is usually 2 to 4 months. And then if you're going to do a type 2, which covers a period of time, it's whatever that period of time is, it's covered, plus a few months after that. Usually 3 to 4 months after that before the report's issued. So there's some general.
Well, we're getting close to kind of the end of our time here, so maybe we'll have, kind of one last question here to wrap things up. And I mean, if people do have questions, go ahead and submit them in the chat. We're happy to cover those as well. But I guess, obviously you guys have all done SOC reporting for many years, and I think SOCs in the crypto space are relatively newer, and I think there's nuances in them, as everybody's kind of alluded to. And so maybe I'll start with you, Michelle. I guess what are some of the nuances in the SOC reporting in the crypto asset space that people need to be aware of?
So a couple things I'd mention first, within the determining the boundaries of your system and scoping out the report. It's surprising the number of organizations out there who are outsourcing different parts of their systems. I mean, classic example, you can have a custodian, but they've outsourced the actual custody to someone else. So understanding some of those nuances, I think, is going to be important, and something that we find a little bit more complicated in this space. The other is anything around cryptographic asset management. It's just more complex and more complicated, and you're going to spend a lot of time there. There are some security standards that are out there that you can reference on helping you design your system around that. But some of the key things there that you're going to be considering are your key and seed generation, wallet creation, anything around key storage and usage, and those aspects are going to be important. And then it's so important to highlight that even if you are in the business of providing what you believe is security over information and data, you still have other controls that are COSO related. So controls around the environment of the entire organization, around your human resources, around corporate governance. All of those pieces are still relevant and included within the SOC reports. So you cannot neglect those areas of your business as well.
It's hard to add to that. That was a great summary, Michelle. I think the bottom line is again, getting back to the idea of a partnership. It's companies are trying to understand what they need as it relates to SOC reports, and then you have the firms seeing, again, new technologies, seeing new processes, and going in there into the environment, performing the audit effectively. But I think there's a bit of learning on both sides, just to provide that transparency. And that's important to understand. Again, there are not a lot of SOC reports out there right now, so everyone's getting involved on this, and it's it's all happening in real time now. So that's everything.
I think we're just about at time. Matt, Michelle, Jacqueline, Rich, thank you so much. I do want to address the one question. I know, Jacqueline, you're entering an answer. I thought we'd address it here and then take a brief break to queue up panel number 3. Ed submitted a question. Typically, will the audit firm also prepare the SOC to be provided to the operating company and its clients? I wanted to throw that out there. And again, additional questions, please email us. We'll make sure they get answered as well. But anyone want to take a shot at Ed's question?
Yeah, I can start. Yeah, you caught me. I was trying to type a response and multitask. But yeah, the SOC reports, whether it's SOC 1 or SOC 2, there's a few sections in terms of what's included in the actual report deliverable. Most of it is prepared by the firm, and it is based on AICPA standards. So there's sections that'll definitely look similar in terms of using same language, same look and feel. There is one section that is created by the service provider, and that's the system description. And I think we alluded to it where we were saying the narrative and the boundaries of the system. So that's typically, let's say anywhere from 15 to 50 pages. It doesn't have to be 50 pages, but I mean, it ranges a bit, but a few pages, company overview. What are the services that you provide? What's the scope of the report? You may not need to scope in everything that you do. So if you're just focused on the custody piece, let's say, just defining that within the report a little bit more clearly. And then you would have some control narrative that mirrors or aligns with what we're testing as the firm. So the HR practices, security awareness policies or training, and I'm just giving examples, but how you manage user access. So that would be the one piece that you would be preparing as the service provider. Each firm probably has a template or typically provides some guidance during the readiness assessment too, just so you don't feel like you're staring at a blank piece of paper trying to figure out how to write, audit style words. So then that'd be something that's part of the readiness too that we can give some guidance on.
Great, Jacqueline. Thank you so much. I wish we had more time. Matt, Michelle, Jacqueline, Rich, again, such a privilege to have you all. We'll be doing this again. Apparently, I'm sitting in the sunset, so I'm going to take that video off. We're going to put you all to attendees. It's great to have you. We're going to take a brief break and bring up panel number 3. Thank you all again. Really appreciate it.
Thank you.
Thank you.
Hey, Amy. Hello, Jessica. Hello, Kel. We're just waiting on Olya. Thanks for joining
I'm here.
us.
Hello.
Hello, hello. We'll be kicking off in a minute. We're just going to see if we can find Wendy, and then we'll turn it over to Amy. Bear with us one moment. We found Wendy. So we'll get off camera. We will turn it over to Amy Miller, who has graciously agreed to moderate our final panel and session for the day. Amy Miller, over to you.
All right, well, good afternoon, everyone. We're at the last session for today, and I thought the prior 2 sessions were very interesting. So we'll finish it off with the most exciting topic of all, taxation of virtual currency. Maybe we'll kick off with a quick introductions. We'll start with myself. My name is Amy Miller. I'm with the AICPA based out of Washington, D.C., and I would work on our tax policy and advocacy team, specifically with our virtual currency task force. And here with me today, we have our panelists. I'm going to start with Kel. Would you like to go first?
Sure, and great to be here today. Thanks for the intro. Kel Canty, I've been in crypto since 2013, founder of a company called Verity. We produce the legible crypto tax and accounting platform, and glad to talk about tax anytime.
Thank you, Kel. Jessica?
Thank you. I'm also happy to be here. My name is Jessica Stumacher. I'm actually an attorney by training. I recently joined Eisner Amper, and I'm heading up our crypto and blockchain our cryptocurrency and blockchain services practice group.
Thank you. And Wendy?
I am Wendy Walker. I'm a solution principal at Sovos. Sovos is a global tax technology company, and we're focused on the third-party information reporting and withholding side of crypto tax.
Thank you. And last but not least, Olya?
I'm Olivier Ramczyk, Director of Tax Solutions at Luca. It's been introduced before. My previous life has been spent in traditional financial services office, giving out tax advice to banks and hedge funds. And it's been an incredible experience trying to translate the traditional tax framework into the crypto universe.
Thank you so much. Okay, so our session today, we're going to try to primarily focus on block rewards taxation and staking taxation, which are just two hot topics right now. And we want to let attendees know that if you want to submit questions in the Q&A, I'll try to keep track of this question and answer. And if we see relevant things pop up, we'll ask it throughout our session. All right, so we'll kick it off with block rewards. First question to anyone who would like to take this one on, could you explain exactly what are block rewards? Wendy, do you want to start us off?
I was going to ask Kel. I think he's better at describing.
Okay.
Go, Kel.
I'll give it a shot. So what happens is, you've heard of miners with proof of work where you have nodes that just act as transaction verifiers. They take in transactions that people are doing on the blockchain. They verify it, but through a process called mining, which is not a great term. And then block rewards are issued to the miner that produce that valid block with the transactions inside that block. And that's what block rewards are in general. In terms of proof of stake, that's a modified or a different way of doing blockchain, wherein people put crypto of that blockchain up to stake, saying that I will promise that I will do a good job. And if I don't do a good job, the network can take these funds away, this crypto away. And then those validators, by using proof of stake, validate the transactions in the network and create blocks of transactions. And then they are rewarded by the network issuing block rewards.
Thank you, Cal, for making something quite complex sound much simpler. So maybe we'll start with, would someone like to kind of quickly talk about what are potential tax and reporting issues right now, specifically in block rewards? Olya?
Yeah, sure. It seems like we have a bit of a coordination issue here. The most riveting panel has been saved for last. Yes, sure. So of course, with mining rewards, what comes to mind is the timing of the reward taxation, as well as whether miners should be considered to be engaged in a trade or business or not. And what does that mean with respect to any kind of expenses or deductions they may or may not take on their tax returns? And of course, let's not forget about the infrastructure bill, right? And potentially sweeping miners into the reporting requirements. But so to break this down one by one, the IRS issued a notice a few years back where they said that mining rewards should be treated as ordinary income, and that should be picked up at the time of receipt at the fair market value at the moment when it was granted. And that's been sort of, that's a traditional conservative treatment of the rewards. Now, a position exists where certain miners may say, well, no, this is more akin to, well, digging out gold, right? And that's not taxed until I sell the said gold, not when I extract it out of the ground. So because nothing is codified at the moment, I think it's really just up to the taxpayer to comment on whether, or to decide for themselves where they sit on the scale of risk, and if they want to be conservative and treat the rewards as ordinary income at the moment of receipt, or defer the recognition until they sell. And of course, when the rewards are sold, then there is no ordinary treatment. It's just a capital gain or loss. I'm happy to continue with the trade or business unless someone else wants to talk about that.
Well, I thought I would just jump in to say, I thought it was a great example you gave there, Olya, and I would say that what adds to that is there is a difference from a third-party reporting perspective. So when you have a transaction that's subject to reporting for ordinary income as a third party, when you have to report that, if it's subject to self-employment taxes, then it's reported on a Form 1099 NEC. But if it's not subject to self-employment taxes, then it's reported on a Form 1099 miscellaneous. And the reason that's important is because what happens? The IRS gets that form, and the IRS is matching that off to an income tax return that the taxpayer files. So to your point, we can take a position to defer it down the road or say that it's not subject to self-employment taxes. But if the third party reports it as a 1099 NEC subject to self-employment taxes or a miscellaneous subject to ordinary income, then they're still going to have to work something out with the IRS down the road because we just don't have clear guidance on how this should all be reported.
Exactly. One just quick note is, obviously I think everybody knows that depending on arguments around the characterization of income, and indeed we'll talk a little bit about, whether that should be treated as income or deferred to later. But at the time you receive that particular reward, that does establish the cost basis for that particular asset. And then afterwards, that cost basis is being used on traditional property rules in terms of long-term or short-term capital gains. And again, that, as was mentioned, is described in fact, this was done back in 2014. It's 2014-21. If anybody wants to go take a look at the original kind of guidance on that, that was the first guidance put out, 2014-21, before the more recent guidance of, I believe it's 2019-24. So just to give you guys in the audience a little reference on, the few definitive pieces of guidance that we have from the service around this kind of activity. Just wanted to mention that.
Yeah,
Well,
and I know.
I was just going to say, I don't know if I would say it's definitive though, right? I would say that my experience has been that we as an industry, at least my clients, are analogizing on that rev rule. So they're looking at the rev rule and they're saying, well, it's a very specific situation described in the rev rule, but because it's new units of income and it's supposed to be new units of crypto that are being taxed as ordinary income, they're taking that and analogizing that to other transactions. So that's my only argument, because I've had a few people get upset with me for saying that.
I totally agree. And the term, that's an expanded use of the term guidance. Let's just say it's better than the FAQs, though. I don't know if anybody caught recently that the service actually kind of made a statement saying that the FAQs can be considered a little more authoritative than we thought in the past, which I thought was really interesting in terms of all the different, changes they made to that, bringing in game currency and leaving game currency. But you are totally correct. Guidance might be a little bit of a stretch, but those are the two things that we've got so far.
Yeah, I think Ron is also tired of hearing me say this, but the AICPA, one of the issues we constantly have, and we've been submitting comment letter after comment letter, is this: we need authoritative guidance and we need more guidance. And one of the things we've seen is, so our task force, we try to schedule a meeting twice a year with the people at the IRS working on the guidance. And, it started out when the notice first came out, they would meet with us and they said they were coming on listening only mode. So we would talk at them about all our issues. And now we're just not able to reach them at all to have a meeting. And, unfortunately, it's true. We all know the resources are short at the IRS. So a lot of the people who were assigned to work on virtual currency guidance and some other things have been, now they're working on emergency COVID related or other new legislation that keeps popping up. So that is what we're seeing. But it is on their radar. I just don't see that the guidance area is a priority, whereas enforcement definitely has been IRS's priority. And then one of our other major concerns, as Kel and Wendy both mentioned, are the FAQs. I actually went and looked at those FAQs today, and on the bottom, it says it was last updated June 4th of 2021. What did they update? Why did they update it on June 4th? And how can something be authoritative if they can just go online and update it anytime? Is there an archive of what it was before it was updated? And what happens when you take that to tax court? So we're very frustrated with that. Okay, so I guess we listed some of the top issues. Is there anything else we're missing in terms of top issues that we're facing or that you're seeing regarding block rewards?
I think we can also talk super briefly about whether being engaged in mining together with others could really be treated as a partnership arrangement. And again, so there are different views on this, because on the one hand, miners who work with others could be viewed as a sort of a taxable association of sorts, or a partnership, but then there are federal and state tax implications with respect to that. And there is always, of course, the compliance obligations. And so it's really unclear as to if you are in the said partnership, who is filing, whose responsibility is that, who is issuing K1s and so on and so forth. Because it is let's say, a pooled resource where multiple parties contribute computer power and electricity and talent to run the operations.
Yeah, and on
Exactly.
a similar note, one of our concerns we've had and we've shared with the IRS is if a partnership is participating in that kind of activity, are they including that on that K1? Is that information being reported so that the partners are aware and can report appropriately? Because it's not required to be on a K1 right now. And so we don't know where that's going as well. All right, let's move over to staking. Let's see, we have a question. Okay, the question is cost basis for rewards based on claim date or receive date, or can it be case by case?
I would say that probably similar, if you go back to the Dominion and Control, which got a large, amount of discussion around, forks and airdrops. I would say that if you are actively staking, then you have control over the address that has submitted the stake, either in a proof of stake or a delegated proof of stake. There's a lot of different ways that different blockchains do this validation and staking process. So there could be various ways of doing that, but typically, particularly for determining cost basis and moving forward on that, and the way that we and other firms that we work with authoritatively, it's at the date of being available to you to redeem, and it's being done at the cost basis at which point it's been submitted. One really interesting thing though, some blockchains might accrue rewards, then as a part of incentive mechanism might actually only grant the rewards if you transact with your wallet as a way of incentivization of activity. So it's sitting there waiting for you to get it, but maybe you have to send a penny, or maybe you've got to receive a penny to show activity. Again, it's kind of a game theory incentivization of economic activity on the blockchain. So there are a lot of questions around it, but in general, once you go down the rabbit hole, you get a little crazy in crypto. So you kind of want to bring it back to either, it's been, deposited and you have control over that. Within, there's certain epoch times where maybe something has to be locked up for a period of time. But basically it would be on primarily in most cases that I can think of as a general rule, that it would be at the time that the reward is granted.
Thank you, Cal.
I would just add to what Kel just said and mention that for some staking protocols, such as those on Ethereum, where you sort of have to effect a transaction in order to receive the actual rewards that were accruing, I would say that they're really not, they do not become taxable until you've actually received them or they've sort of been released from the protocol, because you don't really have an accession of wealth without that. You haven't affected the transaction. In theory, you don't necessarily ever have to, and especially where you sort of have to pay fees and gas fees in order to redeem those rewards. I think that the IRS would probably accept the position that it's not really a taxable, you don't have a taxable event or have any taxable income until the rewards are received. And sort of when you use that method, it becomes a lot easier to sort of calculate the time and date and fair market value of the rewards received, and once they become under your dominion and control.
Thank you.
Jessica, since you mentioned accession to wealth, I just want to quote specific language from that Glenshaw Glass case, which defines income as undeniable accession to wealth clearly realized and over which the taxpayers have complete dominion. It's definitely, yeah. Mm-hmm.
And I know we already got into staking, but could someone give us just a very basic explanation of how staking works and where it is used?
So
Sure.
I'll go again real quick, or unless Olya, you want to give an alternative?
Yeah, I'm happy to. Sure. Staking is basically the process of actively participating in transaction validation on a proof of stake blockchain, where a person pledges cryptocurrency to a network in exchange for staking rewards. Random validators are generally selected in proportion to their quantity of holdings in the native cryptocurrency or the amount of time they've agreed to look up the stakes in a specific digital wallet. And I think there are two main ways you can participate in staking. You can run your own validator node, or you can delegate your assets to someone else who runs a validator node. And that's done through a variety of parties, third parties. So for instance, you can stake on a centralized exchange such as Coinbase or Kraken. You can stake through wallets such as, for instance, Fearless Wallet to stake Polkadot, There is a rocket pool for Ethereum staking and many other providers out there on the market.
Thank you. And I know in terms of, thank you for describing also different types of staking as well. I know in terms of staking, the first thing you see when you look in the news today, it's the Jarrett case. And I tried to find, so basically to give everyone a review of the Jarrett case, there were 2 claims, I think, that were filed, and one was federal income tax law does not permit taxation of tokens created through a staking enterprise. And the second claim was virtual currency is property for purposes of US federal tax law, and that's from the IRS notice. And I guess on August 27th, the Department of Justice answered item number 2. I tried to look everywhere for this answer. I don't know if anyone here has a copy of it. If you do, please share it with me, but I know that it has been quoted that their answer was US denied that virtual currency is in all instances property for purposes of US tax law. And that seems contradictory to the IRS notice. Anyone want to talk a little bit about that? Go ahead, Cal.
So what I think the lawyers there did was, and I was around in 2013 looking at all this stuff back when the original FinCEN definition of virtual currency or convertible virtual currency, but it included a clause around like whether it was in common use, customary use. And so what I kind of think is that, in the interest of completeness and possible, future optionality, what I believe is that they're referring to perhaps small countries that have a custom crypto where it becomes in customary use, where it would be almost to the point of, I take a credit card and I go to any store in Atlanta and I can use it and it's in customary available use. That hasn't occurred yet, but in the definition that came out of FinCEN in 2013, there was that. So I really think that that is primarily an out, and thinking of like if there was a smaller, Monaco or something like that, they had a CBDC or a currency or a cryptocurrency that is in common use, like at over 80-90% of any retail outlet and things of that nature, that potentially could be an optionality based on the definition. So I think perhaps that was just a kind of a point toward a potential future case and making sure that they did it in the effort of completeness, is my personal opinion.
I didn't read the whole comment, so I didn't get to see it, because to your point, Amy, I couldn't find it either. So I don't know what the whole context is. But when I read that comment, my first thought was, well, the notice 2014-21 is pretty clear that it only represents what they call convertible virtual currency. It doesn't represent all virtual currency. It isn't, and that if you as taxpayers have questions about other virtual currency, they welcome your questions and comments. So they make this whole point in, like, I think it's section 3 of the notice to really point out that that the notice is only applicable to what they're calling convertible virtual currency. And so then to me, the question became, okay, so in the Jarrett case, are they considering that convertible virtual currency or not, right? So I don't know, right? None of us really know, but I think that's the question I would be asking, is because, I'll be honest with you, do we think that the IRS thinks that NFTs are property for tax purposes? I don't know. They haven't said, and those aren't convertible technically, right? So I don't know. So I think there's a little bit more to be had behind that comment than we think.
Yeah, I wonder if they are at all thinking of analogizing cryptocurrency to foreign currency, right? And then subjecting it to Section 988 rules.
Yeah.
But doing so opens up a whole other can of worms that probably actually creates more questions than it answers, right? So it would be interesting to see how this develops.
Yeah, and there's a bill moving in Congress. I mean, it keeps getting reintroduced where there's a de minimis or something similar to foreign exchange. I think it's like $600 or less if you make transactions that it's not reportable. So I know we've asked that as well of the IRS and they haven't responded at all. Do we have any thoughts on the first part of the claim that hasn't been answered regarding whether federal income tax law permits taxation of tokens created through staking? Jessica, do you want to take this one?
Okay, sure. Can you just repeat the question again, please?
Yeah, so
Thank you.
I think one of the first claim in the Jarrett case is federal income tax law does not permit taxation of tokens created through a staking enterprise. And that's their claim.
Yep. Sure. So I think that that's sort of the issue here, and the government doesn't really, obviously they're denying it, but I think that the issue here is that, the IRS is saying that it does, and therefore it does. And, the plaintiffs here, I think it's Joshua and Jessica Jarrett, they're essentially saying that that sort of goes against sort of the history of taxation in this country, and that where we don't tax property where you created it, where for example, artwork or something along those lines, and that this is sort of akin to that. And for the first time, the IRS is now saying before you've had a real realization event where you've sold it and you've sort of had, not to repeat the same word again, but sort of the term again, but sort of where you had an actual ascension of wealth, that this is sort of goes against, precedent for the IRS. But I sort of think that the IRS, they're it's up to them sort of as to how they want to treat this. And they've sort of made it very clear that they're taking the position that staking rewards is taxable. So I'm not really sure it matters what they've done in the past or what they've done in different asset classes. I think the law is what it is until it changes, and it's pretty clear that it's taxable, and any income, regardless of whether you've sold it or disposed of those assets received from staking, that is income at the time and date received.
Yeah, I feel like from my perspective, all of the previous communications from the service have been really aligning to that accession to wealth argument, where everything is picked up when it is received and there is no deferral, because you do have that income. But then again, we get into the dominion and control issue, and specifically in the staking context, I think good arguments could be made in instances where taxpayers stake, for instance, Ethereum, which is locked up until the upgrade is completed, right? So it's quite difficult to say that someone has full dominion and control because they don't, right? Of neither the original asset that went in, nor of any accrued rewards until this upgrade is completed. So, but it is probably a big stretch to make this argument for assets like Algorand, for instance, where I can open my Coinbase app and see cents roll up every few seconds,
One thing I'd like to say real quick we did what I consider the real definition of the word staking. I'd like to just be kind of cautious to everybody out there that you're seeing everybody use the word staking in kind of common parlance is to, like, if you deposit, say, some Bitcoin at one of the great venues like BlockFi that can earn interest, and they're doing other business mechanisms behind that in order to generate that, that interest that gets paid out, people are calling that staking. What we're talking about is the original, definition of using staking in a proof of stake blockchain, and some of the even exchanges or other what I call venues where people are saying, oh, I've staked this, or I staked this here, or I stake. That is not necessarily what we're talking about. The things where people are perhaps, lending or generating interest, everyone's just commonly saying anytime that they put crypto at some place and they get something back, in addition to the original amount, that's being called staking. So you need to be a little cautious about determining whether it's the common use as kind of that word has become to be known, or if it's the actual, true, what we're talking about here of staking being used in the blockchain. And then one other quick thing is that concerning the Jarrett case, that's following a lot of the principles that came out of the Proof of Stake Alliance work, along with a great tax lawyer and professor that we did a little bit of collaboration, and he has a tremendous paper that kind of outlines all of it. You can find that at stakingtax.com and take a look at that. However, I would say that, to echo some comments that the IRS, I don't think is interested in discussing it or necessarily doing anything besides, treating it straight as income. And though I technically may agree with the arguments in the case and in the paper, I think for everyone's best interest, we're probably going to be looking at defaulting to, the way the IRS wants it treated for now.
I would like to add and echo that. I agree with you there. I've done a lot of research and a lot of reading on this topic. I've done a lot of thinking about this topic, and I agree with you. It's really hard to say that you don't agree, but on the other hand, there are so many other cases where property is paid in exchange for something and it is treated as ordinary income. So it is hard to, and then you could use so many examples of, equipment being used to create property, or, there's so many arguments about that. But, at the end of the day, I just wanted to echo and say that, again, I have clients who report that interest that you're talking about. And I think that I wanted to kind of highlight that I think that might get a little bit muddy. That water gets a little bit muddy because we do see third parties exchanges report the same 1099s for those, the same box on the 1099 form, they report those rewards as they do for others, as a taxpayer might receive for other staking activities. And so it looks or feels the same, maybe to the IRS or to the taxpayer, right, in terms of that 1099, but it may not, it's obviously not the same circumstances that gave rise to the transaction.
Great point.
And Wendy, I think you highlight one of the key issues that we keep facing with the IRS in terms of the guidance that we need is that we keep asking, we need specific guidance on virtual currency, these situations. And they keep saying to us, that guidance already exists. That guidance on that property, we've heard it so many times.
Yeah.
Just look to this section, that guidance already exists. And
I can tell you that I'm a member of URSAC. I delivered the general report to the commissioner a couple of weeks ago, and we delivered out readings. And one of the major recommendations is around digital assets, and mostly was focused on trading. But one of the key points that we highlight in the report, and I emphasized it when I delivered it that day, and the Office of Chief Counsel was there, and they, one of the things I emphasized was this is the tip of the iceberg. Trading income is the tip of the iceberg. We have staking rewards and lending protocols, and I have clients that have Bitcoin IRAs, and so there's a variety of tax law issues from a reporting standpoint that my clients want to understand. And so I suggested not only this problem with the FAQs being remedied, but we're as a third-party filer community, we're used to seeing there's a variety of publications and instructions and venues by which we get this information, and we're not seeing that as an industry, right? We're not seeing specific examples. I did see some in the W-2 instructions, just so you know, if you pay employees using Bitcoin, I did actually see them put some specific language in there, but that was my recommendation, is like, you need to go out to all these specific pubs. We need to see examples of these transactions written out, and then positions about that. And so I agree with you. This is an area where I want to continue to work and push the IRS to build out some tax guidance for us in this area.
yeah, and I think another issue that we keep raising with IRS as well is, just like you said, as practitioners, we're trying to do the best we can to advise, and sometimes clients, or where we help clients, come to an answer that we really think is the best answer. But what happens when it's the wrong answer? What happens if they marked no on that 1040, but the answer should have been yes? What are the penalties? What are the consequences? And I think that information isn't available yet either. So it really puts a lot of onus on the practitioner to make these guesses. And then I think that just brings us to what else do we think practitioners should be really careful about when offering advice around block rewards or staking? Is there anything else we haven't really covered yet?
I can comment on a couple of things. The slashed tokens, what happens? What should the treatment be? Just as a overall overview, where a validator acts maliciously, the network will punish them and slash their tokens. And so the question comes up, should this be an ordinary or a capital loss? Because on the one hand, you have a capital asset. So at the first blush, it seems that the answer should be intuitively it's a capital loss. But in order for there to be a capital character, there has to be a sale or exchange. And it's not a sale or exchange. It's more like a withdrawal of a validator's right to that asset. The asset is not worthless, so 167 provisions don't apply either. And so it seems like a logical, thought through approach here would be to treat slashed losses as ordinary losses. But I wonder if anyone on the panel feels differently.
I think one of the tricky things, though, you have to keep in mind is what happens where I guess in your example before with Ethereum 2.0, where a user delegates 32 Ethereum tokens to the new Ethereum protocol, and it gets slashed before the upgrade goes live. So they didn't really have access to those tokens anyway for the time being, and they were slashed while they were locked into the protocol. Would that still be sort of an ordinary loss because they didn't have access to the tokens in that year or during that time, and perhaps not for some time after that?
Yeah, great perspective. I still think it would be ordinary. I'll stay with my original answer.
Okay, so we have a few questions from the audience, and I think it goes all across some of the things that we've covered just now. One is, okay, and we get this question a lot, rewards inside gaming software. When the game reward isn't yet monetized to a crypto, what do you do about reporting? Because some of these rewards now, you can switch it back out for other things.
I'd say unless there's a fair market value for it, if it's not yet, switched out for crypto, or there's no way to sort of value it at the time and date received, that you could wait until it is converted into some sort of asset that is easily valued, and that would then it would become taxable.
And the risk of this is just that there's so many kids out there doing this, and our parents supposed to be watching what their kids are buying on Roblox and all that stuff. I mean, that should be interesting.
They should be anyway.
And I think this is, to speak to Wendy's point about the FAQs, actually the virtual gaming currency or gaming currency is one of the questions that was originally on the FAQs from the IRS, and then magically, poof, disappeared. So, it's hard to take a stand when the IRS is adding and removing commentary on exactly the question you're asking.
Exactly. All right, another question we have is, depending what platform or exchange you stake on, let's say Ethereum, can you get different answers for tax for the exact same staking transaction?
I can think of instances where you could have some arbitrage with respect to staking in and out, whether that should give rise to a realization event or not. For example, in protocols which offer liquid staking, meaning you receive a synthetic representation of your staked asset that has its own functionality, and you can take it and go trade it in some other, DeFi liquidity pool, yield farm with it, etc. This probably becomes a little bit more, this is trading much closer to the property for property exchange, as opposed to when you actually just deposit your currency into, for instance, Polkadot, and receive nothing in exchange.
Thank you. And then maybe we'll take one last question. Someone asked, can someone comment on crypto.com stacking rewards can be banked and then used with an actual debit card? Does debit card impact timing of recognition?
I'm in New York. We don't have access to crypto.com, so I'll defer to someone else here.
All right, maybe if we have an answer, we will get back to that person. All right, last question. Is anyone advising clients to pay taxes when they wrap tokens?
Come on, Cal, that's your favorite topic.
That's a whole different subject, and it depends a little bit on the facts and circumstances, right? Are you actually trading ETH for WETH, wrapped ETH? I call it WETH. Or are you actually, an originator that, is where, let's say like wrap BTC, the original wrap BTC, is a product of BitGo. And are you a BitGo doing that where you're receiving it, you're storing and custodying the original BTC and then issuing that? Is that the wrapping? Are you the actual wrapper, so to speak? Or are you the one that is simply exchanging an asset for the wrapped version in order to use it in DeFi? There are a lot of little holes in this and rabbit holes, and again, it's a facts and circumstances type of situation.
Thank you, Kel. Yeah, we definitely can't cover it all in 40 minutes. All right, thank you so much for all the panelists for joining us today and for covering just a few of the small topics of many that are, very hot issues right now that I'm sure everyone is interested in. I think that's it. I'm going to turn this back over to Ron.
Amy, thanks so much. I know we have one last question. Jason's been trying to get this question in. I probably missed it on a previous panel. If we could do that real quickly. I know we're going over. Any recommendations on cryptocurrency trading remediation that recreates a trade blotter to reduce the tax implications for the trading firm? I realize that's probably an earlier comment or question, but if anyone has any thoughts on that, Jason, we'll reach out to you separately as well. But does anyone want to take attempt an answer at that? Alrighty, I will say the answer is no. Jason, we'll definitely get back to you. I apologize to some folks. We missed some of the questions for earlier panels. Amy, Jessica, Kel, Olya, Wendy, all friends and colleagues, really do appreciate your expertise and thought leadership here. That wraps up our event. It's our last official event of 2021. I can't believe I'm saying that. Wishing you all a great rest of the year, a great holiday season. We've got lots in store for 2022 as well, but we'll leave it there. Thank you again. Have a great weekend, everyone.
Thank you.
Bye-bye.
Thank you.
Thank you.